Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Tron Inc. Annual Report. Tron Inc. offers a diverse range of products and services to various industries. At the core of their business are toys and souvenirs designed for theme parks and entertainment venues across 4 continents: the United States, China, Japan, and Europe. These products cater to different categories such as figures, plush items, accessories, apparel, and homewares. In addition to manufacturing and selling these products, Tron Inc. also serves content providers by offering them a platform for their merchandise. This indicates that the company acts as an intermediary between content creators and consumers, facilitating the sale of branded goods. As such, it can be inferred that Tron Inc.'s services extend beyond just product design and manufacturing to include distribution and retail support. The company's global reach and diverse product offerings position it well in the market for theme park and entertainment merchandise. With its headquarters in Winter Park, Florida, Tron Inc. is strategically located to serve both domestic and international clients effectively. Tron Inc. market capitalization of $1 billion is materially smaller than most of its industry peers of roughly $3 billion. Tron Inc. trades at a higher price-to-book ratio of 2.82 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The balance sheet appears very conservative, with liabilities representing only 16% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline can be identified through a thorough analysis of various factors. On the growth side, the issuance of 220 million shares of common stock to Brave Morning and the subsequent payment of $110 million in TRX tokens were significant contributors. Additionally, staking yield from standard TRX staking and energy rental, price appreciation of TRX tokens, and enhanced yields from holding STRX tokens also played a crucial role. On the other hand, revenue decline was driven by several factors. The decrease in theme park orders due to major expansion resulting in decreased attendance had a significant impact. Timing delays for orders from another theme park operator further exacerbated the issue. Furthermore, election year caution among retailers led to reduced buying activity, contributing to the decline in revenue. It is essential to note that some factors did not have a direct impact on revenue growth or decline. These included certain pages with no relevant information, and others where specific impacts were mentioned, but not explicitly stated as drivers of revenue growth or decline. The net income of the company experienced a significant decline between 2024 and 2025, decreasing by $12,471,922. This downturn can be attributed to several factors, including increased allowance for doubtful accounts exposure, tariffs on imported products from China, epidemic or widespread product failure, labor unrest at third-party manufacturer facilities, and writing off excessive or obsolete inventory. The decrease in net income had a ripple effect on the company's profit margins, which also saw a decline. The main contributors to this decline were increased costs due to unavailability of manufacturers or factories, difficulty in forecasting product demand leading to higher inventory exposure, reduced demand for the company's brands and products, and excess inventory, late delivery penalties, and incremental freight costs. The combination of these factors resulted in a decrease in both net income and profit margins. The company faced significant challenges in 2025, including external factors such as tariffs and epidemics, as well as internal issues like labor unrest and inventory management problems. These challenges had a profound impact on the company's financial performance, leading to a decline in both net income and profit margins. The company's financials indicate a lack of positive operating cash flow. The absence of relevant information on operating income or expenses on page 6 suggests that the company's focus is not on generating profits from its core operations. A closer look at the company's performance reveals a negative operating cash flow for its toys and souvenir business in 2025, as stated on page 28. This indicates that the company is struggling to generate sufficient revenue to cover its operational costs. Furthermore, the net cash used in operating activities, as reported on page 50, confirms this trend. The figures of $1,443,401 in 2025 and $2,856,359 in 2024 demonstrate a consistent pattern of net cash being used in operating activities, rather than generated. This suggests that the company is not yet generating positive operating cash flow. The analysis of the company's financial situation reveals a mixed picture regarding its debt level and interest expenses. While there are no clear indications that the company's debt level has changed significantly, there are some potential changes mentioned. Specifically, interest expenses may be affected by a decrease in energy prices and a decline in the value of STRX held by the company. However, on a more positive note, net interest income has shown an increase from -$4,548 in 2024 to $135,411 in 2025. This suggests that despite potential changes in interest expenses, the company's overall financial situation is improving. Nevertheless, further analysis and clarification are needed to determine the exact impact of these changes on the company's debt level and interest expenses. The performance of various segments and regions has been analyzed based on extracted summaries. Unfortunately, some areas have underperformed. International markets and regions affected by geopolitical disruptions have struggled, while certain regions experienced unanticipated shifts or declines in profit. On the other hand, there are bright spots to note. The decentralized finance (DeFi) segment has shown promise, particularly with the company's staking of TRX tokens on JustLend. Additionally, an energy price amendment proposal has had a positive impact on the Tron blockchain's performance by lowering transaction fees. These successes indicate areas where growth and improvement can be achieved. The management of this publicly traded company is optimistic about its future prospects. According to the annual report, the company aims to deliver significant growth through a nimble and low fixed cost production model that reduces dependence on individual content releases. This strategy is expected to drive revenue from various sources, including toy sales, digital asset investments, and staking activities. The company's treasury strategy focuses on accumulating and holding TRX tokens, which it believes have long-term value potential due to the global adoption of blockchain and digital innovation. Management plans to stake substantially all TRX tokens to earn yield, utilizing excess cash for this purpose. This approach reflects a buy-and-hold strategy, with no intention to hedge against market fluctuations. In terms of regulatory matters, the company is aware of potential risks associated with future operations in mainland China, but it currently has no such operations and therefore does not face any filing requirements with the CSRC. However, management acknowledges that its business may be impacted by revised review measures if its subsidiary is deemed to be an operator of critical information infrastructure or a data processor controlling personal information. Overall, the company's outlook is positive, driven by its innovative products and strategic investments in relationships with content providers, retailers, and third-party manufacturers. Management believes that its long-term strategy will yield benefits despite potential short-term market fluctuations. The company has made several significant acquisitions and divestitures over the years. In terms of acquisitions, the company received TRX tokens as payment for Series B preferred stock and warrant shares from its controlling shareholder. It also acquired TRX tokens through token sales and purchase transactions under the BGDL token S&P agreement. Additionally, the company purchased 365 million and 312 million TRX tokens from Brave Morning in June and August, respectively. Furthermore, it invested $18 million in restricted common stock from Black Anthem Limited and agreed to purchase $18 million worth of TRX tokens from ByteT Global Digital Limited. The company also entered into an asset purchase agreement for the acquisition of intangible assets in 2024. In terms of divestitures, the company discontinued operations in the United States following a settlement with the U.S. Department of Justice. It also faced restrictions on cryptocurrency mining and transactions in China due to regulations by the People's Bank of China and the National Development and Reform Commission. Concerns about inventory buildup and supply chain disruption are prevalent in various aspects of a company's operations. One major concern is the inability to accurately forecast product demand, leading to excess inventory levels and potential losses, page 14. This issue can be exacerbated by changes in sales channels and wholesale distributor relationships that may result in excess inventory, page 13. The global supply chain is also vulnerable to disruptions caused by factors such as tariffs, trade restrictions, and labor disputes, pages 15-20. These disruptions can impact the company's ability to obtain supplies, leading to product availability issues. Additionally, the company's reliance on a small number of channel partners increases its vulnerability to losses if these partners were to leave. The COVID-19 pandemic has already caused supply chain disruption and lower net sales, page 18, highlighting the potential risks associated with global events. Furthermore, contingency plans may not be enough to prevent business from being adversely affected by significant disruptions, page 18. In terms of inventory buildup, inaccurate demand forecasting can lead to excess inventory levels, resulting in increased expenses and lost sales, pages 21. The company's toy and souvenir business is also subject to risks associated with underproduction of popular toys and overproduction of less popular ones, page 17. Overall, the company faces significant concerns about inventory buildup and supply chain disruption, which can have a negative impact on its operations and profitability. That concludes the financial summary for Tron Inc. Feel free to comment below, and I will be happy to answer them when possible.